Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha, Darad. Well, due to high demand, we've now expanded our segment from half an hour to an hour itself. So kudos to all our viewers. And we'll now be meeting you every day at this time to discuss our last half an hour trading strategies. So yes, 3 o'clock, that's where you have to be hooked at this point of time. But yes, 30 minutes left for the close and markets have fairly been subdued. If you look at Sensex and Nifty levels, Sensex down about 400 points and Nifty has also slipped below that 25,250 mark itself. IT stocks, that is the one pocket that is feeling the major brunt. We did see heavyweights like Tech Mahindra, TCS, Infosys, Wipro seeing cuts of about 2 to 4% and dominating the Nifty 50 losers list itself. Just when the IT sector was already the top underperformer so far this year, Trump's $100,000 fee hike on H-1B visa spells more trouble for the sector. While brokerages are expecting a mild to negative impact on the sector, yet the sector continued to remain quite well down in today's trading session. At this point of time, Nifty IT index down about 3% itself. But yes, given that the current median H-1B salary for Indian IT firms ranges between $80,000 to about $120,000, the math is quite brutal, given that the visa fee now matches or even exceeds an entire year's compensation. Now, Jefferies has warned that the fee hike will entirely offset EBIT per H-1B employee, driving away a shift from H-1B usage toward local hiring, subcontracting and offshoring itself. We'll discuss more about the sector with our experts in a bit, but yes, on the levels front, we are still fairly at subdued levels. Sensex and Nifty extending its losses to about the second consecutive day. India Wix showing some bit of a volatility. You can see 5% bump up on India Wix levels. However, the broader end of the markets, if you look at small cap seeing a deeper cut of about 1% and mid caps with about 0.4% declines itself. Other than that, apart from IT, pharma and consumer durables, they also felt the pain in today's trading session. If you look at Nifty Pharma, a percent loss coming in there itself. Nifty consumer durables, 0.5% cut coming in there itself. On the other hand, if you look at on the contrary, what actually showcased some resilience in this tepid markets, that is your Nifty Realty index, towering in today's trading session with about 1% gains. Other than that, you can see, financials also held the fort for the much part of the day, but right now it is showcasing a decline of about 0.2% itself. Nifty Auto also flat in the red. Other than that, Nifty FMCG, given the GST 2.0 reforms gets kicked in today, FMCG stocks are seeing a better part in today's trading session. If you look at the top gainers on the losers on the Nifty 50, Adani Enterprises, given that SEBI has given the clean shit to Adani Group companies, that is why you can see Adani Enterprises seeing once again in today's trading session, it's showing a good gains, 4% uptick coming in for the counter. Other than that, Bajaj Auto, Eternal, Adani Ports and Ultratech Cement are also some of the top gainers on the Nifty 50. On the losing end, as I was mentioning, IT stocks, they have taken at the back front. We can see Tech Mahindra, TCS, Infosys, Wipro, all of them seeing a decline of about 2 to 4%. But yes, with that, let's quickly get on board with the market voice of the show. Joining me is market expert Sunil Subramaniam. Sunil sir, good afternoon. Just when we were about to celebrate the GST news, Trump has dropped another salvo on us with this H-1B visa hike. But markets are estimating a mild to negative impact. But how do you see this entire news to pan out? And of course, for the entire IT sector also, which has already been a top underperformer this year.
Yeah, I think that the market is overreacting to the H-1B statement, and I'll explain my reasons for that. So first of all, it's a much watered down version compared to what came out on Friday, right? Now it's only on a new H-1B. And if you look at the data, right, of the 85,000 annual H-1B component, right, about 73% is India's share. So let's say about 62,000. But within the 62,000, the top 5 Indian IT companies last year, 2025, was only 13,000. So it's only about 20% of this that is there. Then who's the major holder? These are the American companies like Amazon, Google, Meta, Microsoft. They are the ones who hog a larger share of the H-1B visas. So that's number one. Number two is that if you juxtapose this 13,000 number against just the top 5 companies' workforce is 15 lakhs, 1.5 million. So it's less than 1%, right? The third aspect here is that I know you mentioned some that Jefferies saying that on EBIT per H-1B employee. But the fact is that the Indian IT companies over a period of time, given the lottery system, the nature it works, have already moved, and 20 to 50% of their onshore American work is already done with H1B, and the rest is already local American hires. So the Indian IT companies have been smart, they moved along, and it's a very small proportion of this. And effectively, I see that this has actually caused a death knell to the H1B program itself. Because I don't see, and as you mentioned, between $80,000 to $125,000, they can't afford to shove off $17,000. If you take a 3 plus 3 extension, it's $17,000 per year. They can't afford to take another 10%. Rather, they pay another 15% for a local American employee. So I think that Indian IT companies will gradually phase out this H1B incrementally, and hence I see that on an EPS hardly 2 to 4 basis points impact. That being said, there's a sentiment which is negative, the overhang, and on an already beaten down sector, people are just jumping on and piling onto it. So if you see the year-to-date performance, Nifty, I think I remember was about 7% up. The IT was down 17%. So you're talking about a sector which has year-to-date 25% underperformance is further getting beaten down today. So I think it's in a very highly oversold position. I think, yes, there are overall, apart from the H1B, the AI challenge, the slowdown in America's challenge, all of which have contributed to this. But I think that these companies are strong enough to manage and to go past this. H1B is a very small component of the total employee pool. So to me, this market correction, if it persists in a day or two, continues, is actually a buy on dip strategy, because it's also overlaid with a negative FII outlook post GST also. And that's because they are waiting for good news on the tariff front. And there is good news coming along there. Mr. Piyush Goyal is going to reciprocate the visit of the US Trade Secretary and go over there. So I believe that if you go by the CEA Anantha Nageswaran's statement that by end November we should see significant relief on the tariff front, that could be a trigger for an FII to return. And when they return, mind you, especially passive funds, right, have to buy 10 to 11% of the stocks in the index are IT stocks. So there will be buying support coming in. So I believe that if you have a slightly aggressive risk appetite and a slightly medium term outlook, it's actually IT sector is, to me, in an oversold buy on dips territory. It's a brave call, but I've been sticking to this for quite some time now. And I think, like I said, the incremental impact, if you analyze it, is only at the margin.
Okay, okay. Sunil sir, also, if you look at the mid-cap IT firms, Coforge, Mphasis, all of them came out and they said that they won't be seeing an incremental impact into their financials on the back of this announcement itself. Would you say that mid-cap IT firms are better insulated at top-tier IT firms, or would you still stay constructive with your view that the entire IT sector is right now a buy-on-dip strategy given their oversold
actually, the mid-cap IT companies tend to be far more US focused than the larger ones. The larger ones are diversified. They are about 50 to 60% US exposed. But whereas the smaller companies are probably 80% plus US exposed. So naturally, their reliance on the H1B program might be slightly higher and there could be impact. But I think that given the nature of the business model of these people, I think they will be the first to move into AI-based consulting, where pricing challenges will not be there so much. So they could actually start hiring local American talent there to substitute. So I think that the larger companies are the ones which can easily weather the storm. But the smaller companies, longer term, they will recover, but shorter term, there will be a greater impact because they probably lay a little more on the H1B program than the larger ones.
Okay, okay. Sunil sir, also let's talk about banking stocks because they showed a bit of a resilience today after 2 months of back-to-back losses that we've seen in majority of the counters. How do you see the early signs of credit pickup?
Hello?
Because Street is estimating that given the GST 2.0 cheer, we can see some credit demand to pick up, and therefore it could aid the lenders going ahead into the second half of the fiscal year also. What is your take?
So my take is that the festival season could actually turn out to be some kind of a pressure on margins, because I think that combined the corporate sector, the banking sector, and the GST cut aided have to put all their forces together to make the consumer to buy. Now, the biggest challenge we have faced as a country is that mass market consumption hasn't picked up. It's been a K-shaped consumption recovery. The costly items are selling very well, big houses, big cars and everything, but the mass market is not moving. So I think that this is a time when the entire system will come together. And so I would say that the lenders, private sector lenders, whether they be NBFCs or the banks, would tend to sacrifice their NIMs and put more into the, reducing the EMIs in conjunction with the corporates, right? To try and push the product off the shelf. So I would say that loan growth will be good, but not necessarily the NIMs will be expanding in this period. But that's okay because it's a price into quantity game. So if the volumes are good enough, then even a smaller NIM means absolute EPS growth will be better. I would say that a better bet within the financial space is the PSU banks because I'm seeing that as a second collateral reaction to this consumption boom, which I expect in the festival season, is that capacity utilization should step up because of the top line growth. I have no doubt about the festival season being a big success in terms of sales. So the top line growth of all the companies, consumption companies should grow. And as a result, capacity utilization should creep up. And I expect the private sector capex cycle in about 6 to 9 months to really get up speed. And when that happens, the capex cycle, the execution is in the SME and the MSME segments. And lending to them is the forte of the PSU banks. So I would say that with a bit of a lag, it is the PSU banks which will be able to lend at that place, so their loan growth will be good in that time frame. Plus, the NIMs will also be very healthy because lending to the MSME segment is probably at 12 to 14%, much higher interest rates than your typical vehicle loan or your housing loan. So to that extent, their NIMs also will expand. So I think that within the financial space, with a slightly medium-term approach, I would back the PSU bankers at this point. As far as the private financials are concerned, I think, like I said, it's a trade-off between volume growth and NIM compression, which overall I still will play out well.
Okay. Sunil sir, of course, now that we are talking about, banking credit pickup as well on the back of the GST 2.0 cheer, I also want to understand what is your biggest bet after the GST announcement itself. Any particular theme that you are looking at apart from, of course, autos, which is touted as the biggest beneficiary out of it?
Well, yes, but to me, again, like in IT, where I have a contra view, I have a slightly contra view here that it's actually the sin products, or which the market will tend to take a negative reaction to because they're going to be taxed at 40% GST, but actually their sales numbers will not drop because these are price and income inelastic products. So to that extent, any price hike because of the higher GST is not going to lead to any drop in their sales, but the market is probably reading it, saying that they'll get hurt by this. And so to me, a contra buy within this whole space is actually the sin good companies. Okay, so that's one call which I would like to take. Second is that I think that ultimately the biggest beneficiary in the short run, due to the festival season, auto will be the top gainer in terms of sale volumes. But the longer term, the leverage end of the leg, the biggest impact will be felt in housing. People upgrading their houses, if they're now trying to buy a 2-bedroom to a 3-bedroom house, if they're looking for a small house in the city to go to a larger house on the outskirts, this is the trigger because the GST has also ensured that cement and all the building material products are also coming down in price. So I expect the affordable housing related segment to also get a big boost. It'll take time for the developers to launch the products at those reduced prices. So give it a bit of time. But with that medium term outlook, I believe that it's the real estate sector which will really benefit from a GST cut in terms of the cascading effect of not only cement products coming in, but the bank's EMIs dropping there.
Okay. So, sir, would you also suggest that affordable housing sector is something which is going to be the dark horse going ahead, given that you already said that Realty is something that is going to benefit out of the GST announcement?
Absolutely. And I think that because the real estate developers will now come about, I mean, they buy fresh parcels of land as opposed to going for a big ticket housing project, they will now split into smaller units. And those launches in the coming season come through. Now, this monsoon season is a little bit of a down for real estate overall. But once we cross that and cross the festival season, people don't go and buy houses on Diwali, right? People buy cars on Diwali, people buy consumer durables on Diwali. So give it a bit of time. But I do believe that That's the revolution which even the government would want to support very actively, because it's also an employment generator, the construction and housing segment. And these are longer term loans which don't get paid down. So to that extent, right, you have a sustainable growth path there, or the multiplier effect of the housing segment is also seen in the cement, the steel, the building materials, the metals, the copper and the aluminum for wiring, and a whole bunch of industries, sanitary ware, tiling, you name it, right? So paints industry. So housing has a big multiplier effect on the economy. And I think that I wouldn't rule out that the government may in fact come out with some further incentives to give housing a boost.
Okay. So, sir, I want to understand. We had an interesting report that came out by JM Financial today on Swiggy itself, where they've highlighted that the company needs to build up its cash chest to survive competition. I mean, this has been a concern for new age companies when they actually tapped into the markets itself, that is, the depleting cash reserves. How do you view this concern, and would this change your stance towards the new age businesses?
No, you see, this is always a chicken and egg story, right? They have to burn cash in order to build scale. And so when the companies, if they survive this cash burn, then they'll rake in the money. You see, all the new age companies, you see the big successes today, right? And Amazon or whatever in terms of its history, they all burn cash in their initial periods. So the key is that at this point, when your analyst looks at it and look at the cash and say for next year they need to spend so much, they don't have it, you tend to take a negative view. But the point is that for them to raise, they just have one more series of funding, either do another follow-on IPO or to do go and raise some lending from some private equity people. And I'm confident that they will be able to manage that because they are a large enough engine, core engine already chugging along. It's not a new startup trying to prove itself. Right. So to that extent, I believe while yes, the report says that it's a bit of a concern, and I would broaden this to the entire pack to say that these are high risk businesses which will throw up cash in the long run because they have large volume segments. But till they build that cash, they have to burn cash, right? To build the cash generating engine. So it is obvious that in the short run, there is a high risk of failure. Now you want to build that probability in, and that's why these brokerage houses say that it looks a bit tough and I'm downgrading it. I would actually look at it and say the best way to play these kinds of high risk plays is to diversify across the pack. Because you're saying today that they have downgraded Swiggy. Now, who knows that next week some other broker comes and says that downgrade Zomato, somebody else downgrade something else. So the point is that these businesses are in the nature of high risk, high reward, who are betting on the volume game and a changing mindset of the people game. So you have to have that patience. There will be winners, there will be losers. So unless you diversify across the pack and take off your focus and attention from individual companies seeing what they do, because you don't know what their plans are, how they're going to do it. They're also smart people at the end of the day. So I would say diversify across the pack, because then there will be some losers and some winners, but at least overall the pack will end up expanding the market for this category and the benefits will flow in. One or two failures are there, your diversified portfolio should be able to absorb that in your portfolio. So I have a different approach saying participate but diversify.
Okay, participate but diversify your investments. Okay, Sunil sir, now that we discussed a whole range of sectors also, let's talk about like what is the next trigger that will drive the markets from here on. We've had the Trump's bomb right here, but before that GST news that has fairly been priced in by the markets itself. What is the next thing that the markets are keenly looking forward to now?
No, absolutely. It's again the T word. It's the tariff, Trump tariff thing. And I think that Mr. Piyush Goyal visiting there, all indications are that November, that's a month after Diwali, is when we expect to close this out. So in the markets, if you see a good festival season in terms of sales, will create a nice mood. The next is that this October result season, I would say the expectations from the result season shouldn't be kept too high because till September 22nd, people have postponed their purchases because of the GST announcement. So this quarter's numbers will be a bit thanda, if I use a Hindi word. And so don't let too much stress on this. But this results quarter will also tell you that how's the future going to look, because by the time the results come out, Diwali will be on us. So when the result season is going on, Diwali sales will be going on. So each company will give you a sense of how that's looking. So the conversations of the earnings season are more important than the earnings season itself. And these conversations are around, hey, how is Diwali going? And then second, how's your next year's guidance looking? Because this is the crossover. This is the quarter when all analysts shift their focus from FY26 to FY27. So when you take then one more year earnings in, and if you take a nominal GDP of we are around 9% now, take that as the earnings will come as that plus couple of percentage points and take that into the valuations will start looking more reasonable. So I think a combination of the festival season says the market's outlook looking 1 year more forward and some positive news around the tariff front in terms of at least an interim deal being signed are three of the triggers which would finally make that prodigal son, the FII, to come and make a positive shift. Because ultimately, I'm telling you, domestic money is going to buy something, is going to be sector rotating. So domestic money will prevent the market from falling too deeply and will be consolidating the market because there will be sector rotation. It's only when the FIIs come in significant number that the market can touch a new high. So one hopes that in the months of October and November, these three factors put together, the tariff, the sales, and the market's outlook shifting to the following year, come through, and if all things click, then markets could touch new highs. So I think these are the triggers that I would actually wait for.
Okay. Just, one last question before we let you go, Sunil sir. I want to understand, you mentioned that, earnings is something that the FIs are waiting and keenly watching out for because before they actually completely convict themselves into coming into the Indian equity markets. But I want to understand from a 1 year perspective, in the last 1 year perspective, gold ETFs, they have risen out and they have actually outperformed the benchmark Nifty 50 index. So if a new investor has to invest into a pocket of the Nifty 50 markets, what would you suggest? Gold ETFs are the way to go, given that the Fed has already indicated that 2 more rate cuts are also expected from this year itself?
So I would say that, gold is definitely an important allocation that they need to have, but not in isolation. You've got to have silver also, because there is a shift that gold is getting too expensive, so some amount of reallocation to silver, and the gold-silver ratio is currently favoring silver rising faster than that, because I think the long-term ratio of gold to silver is 60-1. Today we are excess of 90:1. So there will be a longer-term trend of silver catching up with gold. So I would say silver also will play its part. Now, to play both of these together in the portfolio, there's also the category called multi-asset funds, which most mutual funds have as a category, which has equities which are largely large cap with a little bit of debt and some gold and silver. So I would say that that's also a tax efficient way because these are equity taxation products. So yes, if you want to take gold and silver ETFs on your own as a part of your asset allocation, well and good. But using multi-asset funds are also a good way to play the gold silver boom along with the equities play. So I would say multi-asset funds should definitely be in one's portfolio at this point in time.
Okay, all right. All right, with that, we have to let you go, Sunil sir, but thank you so much for your time and connecting with us. All right, let's take a quick check of the markets. Just less than 3 minutes to go before we go to the close. But yes, Sensex is exhibiting a downside of about 429 points, and Nifty is also slipped below that 25 to 50 mark. But without much further ado, let's quickly get on board with our technical expert of the show. Joining me is Aamar there. Okay, all right. All right, we'll just take a quick check of the markets, how we are faring at this point of time. Both the Sensex and Nifty have been exhibiting a downward trend. Nifty about 100 points downtake coming in for the Nifty as well. If you look at the broader end of the markets, of course, they have ended the 11-day sprint that they were exhibiting, and of course, you can see the mid caps have given a cut of about 0.5% itself, and small caps with about 1% decline also. Nifty Auto Index also has given up its gains, and it has slipped into the negative territory with about 0.3% declines. Bank Nifty also with a larger cut of about 0.3% declines itself. Given that Bank Nifty throughout the day was trading in that positive territory on hopes of some credit demand revival, like we were discussing with our previous guest itself, but some pressure has been present in the Bank Nifty index, and they have succumbed to the selling pressure at this point of time. On the other hand, if you look at Nifty IT index, one of the top sectoral underperformers of the day, 3% cut coming in for the Nifty IT index. Whether or not this downside can be contained or not, that we'll understand from our next guest of the show as well, how the technical charts actually present before us. Other than that, Nifty Pharma Index is also showing a subdued trend with about 1% loss coming in for there itself. what is doing well in the subdued markets is your metal index showcasing a gain of about 0.3% gains, and the Nifty Energy Index also showcasing a gain of about nearly a percent or so. But yes, let's quickly get on board with a technical expert of the show. Joining me is Aamar Singh of Angelone. Aamar, good afternoon. How do you see the market set up today? Of course, we are way below that Nifty is way below that 25 to 50 mark at this point of time.
Yeah, I would say that, this is more of a reaction with regard to the announcement that US President had made. So I wouldn't read much into it. So markets are basically trying to absorb that. And also we have some news that senior Indian ministers from the cabinet are going to hold talks on this. So I don't think there should be much of a cause of worry. As far as the levels are concerned for Nifty, I would say 25,000, 25,200. This is an important zone of support, and resistance upside 25,500, 600 immediate zone of resistance. If you look at the charts technically from a short-term perspective, the trend remains strong. There is momentum. And also what we are seeing is that if you see across the board in terms of the advances versus declines, today is an exception, but more or less we've seen some very strong momentum in the mid cap and the small cap segment. So I think that's also helping the market. So the broad base rally is there, and also looking at the macros in terms of the GST means implementation and cut implementation, all that. That's going to bode well for the market. So I'm positive on the markets, but yes, upside 25,500, 600 immediate zone of resistance. If that is taken up, then we are definitely headed higher. And I think over the next few weeks and months, we should see positive momentum build up.
Okay, all right. Let's take a quick check of the markets. We have closed in the negative territory. If you look at the Nifty is also closed below that 25 to 50 mark. Sensex is also closed down with about 430 points. If you look at majority of the sectors, if you look at Nifty IT index is closed with about nearly a 3% cut, and Nifty Auto Index also showcasing a cut of about 0.4% decline. Bank Nifty with about 0.2% decline coming in there as well. Nifty Pharma Index also showcasing a larger cut of about 1% itself. Mid cap and small caps, like I was talking about earlier, ending its 11-day winning streak itself. And the top losers on the Nifty 50 continue to be the heavyweight IT stocks. That is your Tech Mahindra, TCS, Infosys, Wipro, all of them showcasing a decline of about 2 to 3%. But yes, let's get back to Aamar. Aamar, this sharp fall in the IT stocks, would you say that this is contained, and most of the news that came out from the Trump's front has been already priced in? How much of do you think that the downside is capped from here on?
So see, if you look at the IT stocks, we definitely see some very strong down move in most of the IT stocks. And as far as HCL Tech is concerned, or for the Coforge is concerned, we've seen that sell-off happening, and Infosys is also down by 2.5%. But I would say that, yes, it is definitely a challenge for the IT companies as to how they fare it, but with the clarity that it's going to be applicable for the new H-1B visas. So that is something. So the companies, how they actually play around this and how they're able to manage it to the best of their ability is something which is going to definitely matter. But yes, I would say that markets have more or less factored in. I don't see much of a further downside, because we've had some strong down moves. If I look at TCS is down almost 3.5%. So TCS, I would say, is a very good level for entry at TCS. I've been seeing it for quite some time. Somewhere around 3,000 is a very good level for entry. Upside 3,200, 3,300, that's a zone of resistance. So I would say that we could have seen the worst over in the IT space until there's something new comes up.
Okay. Aamar, we'll also talk about the Bank Nifty index. Of course, it slipped into the negative territory, but for the much part of the day, the Bank Nifty index was showcasing some kind of a resilience in today's market also. What are the next levels that we can watch out for Bank Nifty index?
See, if you look at Bank Nifty is clearly indicating that the upside seems to be capped right now around the 55,800, 56,000 level. That seems to be capped. Currently, it's around 55,200. So we've seen some sort of correction. On the downside, however, Bank Nifty is very strongly supported around the 54,000 54,800, 55,000. So it's a narrow range for Bank Nifty. What I would say is that if we go back and look on 18th of August, it had made a high of almost 56,100, 56,156 to be precise. So that is going to act as an immediate zone of resistance. So 56,000 whereas 56,200 on the upside is going to act as a zone of resistance. But on the downside, I would say 54,800, 55,000, that's an immediate zone of support. So we could witness some sort of consolidation. But overall, if you look at the macros also, somewhere or there, there's going to be some support for these banks as well.
Okay. Now let's also discuss about the Adani Group stocks. Once again did well in today's trading session after the SEBI's clean sheet. Among the group stocks, anything that you're finding technically more strong for an upside going ahead? We did see Adani Enterprises and Adani Ports, all of them exhibiting good gains in today's trading session as well.
I would say definitely whoever has had the courage, I would say, to enter, because it was quite volatile. But the news definitely has acted as a trigger, and we've seen some very sharp momentum. Because if you look at Adani Power itself, the way the stock has rallied, it's inching closer to its all-time highs. So all-time high was somewhere around the 179 or so. Currently, it's around 170. If you look at Adani Green, so Adani Green is still far away from its all-time highs, which was, if I look back, so that was somewhere around the 3,050 mark. Currently, it's around 1,100 levels. So sustaining above these levels, we could witness an upside move here as well in the stock towards the 1,400 levels. And if I look at the Adani Enterprises, because Adani Enterprises is something which has also seen a sharp move. It needs to sustain over the 2,650, 2,700 level for any further upside towards the 3,000, 3,200 mark.
Okay, all right. Let's also discuss about shipping stocks, because that also did well in today's trading session. Cochin Shipyard, Garden Reach, all of them saw a gain of about 1 to 2% each. Now, this came on the back of Indian government granting infrastructure status to the large ships, and the status upgrade is expected to make easier for shipbuilders to raise capital as well. Aamar, how do you see the gains today, and where do you see it going from here on?
So see, first talking about Cochin Shipyard, clearly Cochin Shipyard has bounced back from 2,400 levels. It was down towards 1,600 odd, and then it has bounced back towards 1,920. So I would say the trend is positive, but on the upside, Cochin Shipyard is likely to run into a wall of resistance somewhere on the 2,100, 2,130 zone. And looking at the other stock also, Garden Reach. So Garden Reach is also having a similar pattern as Cochin Shipyard. So again, on the upside, if I look at Garden Reach, so somewhere around the 2,750, 2,800, that's a zone of resistance for the stock, and the stock could witness some sort of consolidation.
Okay. Let's also talk about Voltas, because that also fell in today's session as we saw BofA Securities sharing an underperform call on the counter, citing some near-term weakness in the weak summer and high inventories. They believe that the counter could face another 5 to 12% contraction in FY26 itself. Aamar, how do you see the counter? The stock has been an underperformer so far this year, but what do you believe the next moves to be?
So see, if I look at Voltas clearly, as you rightly said, it has been trading consistently in a sideways manner on the downside. If you look at Voltas, so it has got good support coming around the 1,130, 1,200 levels. On the upside, resistance is somewhere around the 1,470, 15. So it's more of a trading range play. There's no momentum on the upside. Upside seems to be capped because till the time we don't see it sustaining over the 1,500 mark, we'll not witness any significant rally. And some of the long-term technical indicators, they continue to be very negative. So that effectively means is that higher levels will be sold into. On the downside, yes, the stock does have very strong support around the 1,150, 1,200 zone.
Okay, all right. Just one last question before we let you go, Aamar. Any top picks that you want to highlight before you go at this point of time in this market?
Yeah, so if I look at some of the stocks, SBI is one stock which continues to remain strong and positive on the charts. It has witnessed some up move here. So any pullback in the stock towards 840 odd levels could be a very good buying opportunity, because the stock has got very strong support below the 820 level, and on the upside, the stock has the potential to rally towards the 900, 915 levels.
Okay, all right. All right, with that we have to let you go. Aamar, thank you so much for your time and connecting with us.
Thank you.
All right, let's quickly get on to my next, my colleague Yatin Mota, who is joining from another newsroom to decode about how these markets have been. Yatin, good afternoon. Nifty down for the second straight session, and this time it was the IT stocks that hampered the sentiment.
Absolutely, and the IT stocks are clearly under panic after the H1B announcement, relating to the visa fees came in from President Trump's office. If with the initial confusion, finally we had the press, secretary clarifying that this is only for new applications and the $1 lakh fees really applies on the new applications based on the lottery system. Obviously, why Indian IT companies? Because nearly 70% of H1B visas which are allotted in the US are to Indians, and yes, most of the IT companies, including the frontline IT companies, about 1 to 2% of the workforce is working overseas with a H1B visa. So, whether or not it impacts sentiments, whether or not there will be further visa rules tightening by the US is something that the markets probably are now factoring in the price. The uncertainty in the Trump administration with respect to the tariffs and now the kind of visa inclination is showing that not even services would be spared. So yes, IT stocks clearly getting badgered in trade. However, we had Coforge and Persistent announcing to the stock exchanges that the H1B visa will not have a material impact on their financials.
That's right. IT stocks are clearly one of the top sectoral underperformers of the day itself at this point of time. But let's, like Yatin was talking about that majority of the mid-cap IT companies from Persistent to Coforge and Mphasis, all of them have reiterated that business is going to be as usual. The impact could be seen in large-cap IT names like Infosys, TCS, Wipro and Tech Mahindra and the peers. Now, how the street has been viewing this impact, if you look at BofA Securities, they believe that the new H1B visa norms pose a gross pre-mitigation EPS risk of about 7 to 17% over a 3-year period. And companies now have a clear 12 months planned and kick-in mitigations like offshoring and nearshoring itself. On the other hand, if you look at Jefferies, they expect the talent supply crunch to drive up the on-site wages, and that could drag profits by about 4 to 13%. Adding to that, the growth may also be slow amidst the operational model shifts and the AI risk itself. Among the large cap stocks, Jefferies sees that TCS and Infosys, that is well placed. However, Coforge is the best placed among the mid cap names. CLSA also believes that the issue will have an impact, but it will be quite limited as it will be applicable only for the new applications and not for the renewals or on the overall stock of the visas itself. It expects up to 6% of it, the impact to the FY27 for Indian IT companies under their coverage itself. So yes, all in all, we did see a gap down start for the IT index also, and over the course, it did trim its losses. But yes, experts have been highlighting that the impact could be overstated and earnings hit will be minimal, but the larger damage of wage inflation and talent crunch could be felt. But yes, let's move on to our next stock in focus, that is your Swiggy. That share has declined in today's trading session, given that JM Financial downgraded the counter to about reduce from its earlier rating of hold and marginally trimmed its target price to about 420 from 460 rupees itself. Now, what the brokerage has said that the Swiggy's balance sheet remains a cause of concern and requires remedial measures. Now, these remarks do come at a time when reports have been indicating that the company plans to sell about 12% stake in Rapido to recapitalize its balance sheet. Now, at this time, analysts also believe that Swiggy would need a much bigger war chest, as Swiggy's entire stake in Rapido can fetch up to a maximum of $320 million when they actually need $500 million to actually recapitalize themselves. They believe that Swiggy is depleting fast on its cash, and there are some growing competitive threats which it needs to take from its peer itself and to stay ahead of the competition itself. Moreover, with Blinkit's guidance suggesting plans to double its store count over the medium term, the brokerage believes that Instamart's curbed expansion strategy runs the risk of meaningfully falling behind its ambitious competition itself. Yatin, earlier when the new age companies had come to the D Street, many experts lacked the conviction in these counters because they did not see a clear path of profitability. And now, after gaining confidence, this brokerage report further raises the caution on whether it indeed is burning more cash instead of, at the stake of growth.
Yes, I see. Historically, we have seen Swiggy's valuation discount to Zomato, and that is probably because of market share only. And with the quick commerce business picking up, there will be accelerated growth. It's not that the growth is missing. Yes, to a certain extent, market share issues will be there, but still a lot of other brokerages believe that the quick commerce pie is something which will keep shares of Swiggy as well as Zomato quite active in trade. So on an overall basis, we haven't seen much of a impact, but yes, Swiggy has always been at a discount for the same reasons. Probably market believes that Zomato should get a better valuation given the fact that it has a leadership position.
That's right. That is a stock that we need to watch out for as well. Let's take another stock in focus, life insurance stocks, because we did see HDFC Life, LIC, SBI Life, all of them trading higher following a brokerage note that came in from JP Morgan itself. Now, JP Morgan has upgraded HDFC Life to overweight, and they've also revised the target price to about 980 rupees, up from 750 rupees. And they've also upgraded GIC RE to an overweight call, with the target price raising from about 480 from about 197 rupees. LIC also remains the top overweight pick with a price target of 1152 rupees itself. What analysts have been saying is that the sector's compounding momentum is expected to continue, supporting further balance sheet growth. And for life insurers, the brokerage has been forecasting about 15% annual growth in new business value. And for non-life insurers, they're expecting to see about 12% annual growth in book value over the next 3 years itself. Now, the brokerage has also added that the greater clarity on GST and related product strategies could also act as a near-term catalyst for all of these insurance stocks, potentially boosting investor interest in all of these counters itself. Yatin, if you look at so far this year, both SBI Life, HDFC Life, they have been outperformers, and now the street is quite optimistic on this sector too, given the GST reforms that became effective from today onwards.
Yes, this is one sector to watch out for, because insurance anyways is underpenetrated, and most of these stocks also have underperformed in the last few years. But yes, HDFC Life, SBI Life, all of them have done exceedingly well in the last 24 months or 12 months period. But yes, SBI Life clearly outperforming the entire pack.
That's right. Now, let's also talk about Voltas itself. Yatin, why don't you take us through, because we had an interesting brokerage note that came in for the counter.
Yes. Yes. So, air conditioners have seen a drop in GST rates from 28% to 18%, and the street is expecting that there could be a revival in sales. Now, what Voltas had to say today is that there could be a chance that the dealer inventory, which is quite high this time, that would take time to get cleared, because we had a summer season which was mild, followed by a good monsoon. So, on the ground, air conditioner sales haven't picked up. So, by the time you have the benefit of the new GST regime and the clearance of the stock which is already with the dealerships, most of the AC companies are now guiding that probably in the medium to short term, AC sales will take time to revive. However, a lot of things depend on the upcoming summer season. So, in the short term, yes, there is GST benefit which would be given to customers, but probably in the coming quarters, the summer intensity is something that we will watch out for, because a lot of dealer inventory carried forward from last year's failed season is something which has kept the stock worried. BofA also believe that the demand has not yet picked up since Q2, and probably in the festive season we will watch out for the sales number. Today the stock, after this management commentary, was down nearly 3% on an intraday basis.
That's right, Voltas, that is something that we need to watch out also, and given the entire consumer durables pack also felt the heat in today's trading session. But for now, that's all the stocks we have for today. We did start the week in the red, but let's see whether the news gets digested and the markets can move on from here on itself. Because we have Union Commerce Minister Piyush Goyal is leading the delegation in the US for the trade agreement. So more developments could be watched from here on itself. But before that, let me introduce you to Moneycontrol Super Pro, which can be your ultimate investment power. You can get all the live calls and trading and investment ideas from SEBI registered experts, pre-identified chart patterns, and AI-powered stock alerts on WhatsApp to help you trade and invest with confidence. Download the Moneycontrol app and subscribe to Super Pro itself today to get all the alerts on your WhatsApp.